VT dominated the 3-year race with 69% returns, while VOE lagged at 40%. But VOE closed the gap over 5 years. Now let's shift gears and look at VT's 29-point lead over 3 years. Means you're doubling your money while others are stuck spinning their wheels. But here's where it gets interesting. Over 5 years, VOE's 67% nearly matches VT's 69%. Patience rewarded as the gap virtually disappeared over time. In plain English, think of it like race cars. VT sprinted ahead early, but over the marathon, both finished together. Different speeds at different laps, but similar long-term destinations matter most. VT's 1.2 Sharpe ratio means you're getting solid returns without taking wild risks. Efficient performance that's hard to beat. Here's where the story takes a turn. VOE's 0.7 Sharpe ratio is rough. Getting half the risk efficiency of VT means worse returns for every bit of volatility you're eating. Let's break this down further. VT's 1.1 Sharpe ratio over 3 years shows it's delivering solid returns without taking on excessive risk. That's consistent performance. Now let's shift gears and look at VOE's 0.6 Sharpe ratio. Shows you're not getting much return for the risk you're taking. Pretty inefficient across the board. In plain English, Sharpe ratio is like mechanical leverage. VT climbs efficiently with every push, while VOE needs twice the effort for the same height. When you're climbing toward returns, efficiency isn't optional. Let's dig into the details. VT's 1.5 Sortino ratio shows it's delivering solid returns while keeping those painful downside drops notably under control. Here's where things get revealing. VOE's 0.9 Sortino ratio shows it struggled with downside protection. Not great when markets got rough this year. In plain English, the Sortino ratio is like a seesaw that only cares about the bad drops, ignoring upward volatility. VT balances better because downside risk is what truly matters for your portfolio. But wait, there's more to this story. VT's worst drop was just 17%. That's the kind of shallow crash that lets you sleep at night during market chaos. Here's the thing though. VOE's 18% maximum drawdown is just 1 point worse, but in a crisis, every percentage point of protection matters. In plain English, think of maximum drawdown like a swimming pool. VT stayed in the shallow end during downturns, while VOE dove a foot deeper. Recovery's always easier from shallower water. Now here's where it gets tricky. VT's 38-day recovery is impressive. Back to break even fast means your money isn't stuck waiting on the sidelines forever. But that's not the whole picture. VOE took nearly 4 months to recover, almost 3 times longer than VT's 5-week bounce back to break even. Let's see how this plays out. VOE took 136 days to recover, while VT bounced back in just 38. That's nearly 4 months of waiting versus 5 weeks. In plain English, here's the rocket blast-off truth. VT recovered in weeks while VOE took months to get moving. When you're stuck on the launch pad during a rally, you're bleeding potential returns every single day. Now let's connect the dots. VT spreads your money across nearly 10,000 companies worldwide. That's diversification taken to the absolute extreme here. But hold on a second. VOE's portfolio is highly concentrated with just 185 stocks, meaning each position carries more weight and potentially more impact on returns. All right, pause here. Who's winning this battle? Drop VOE or VT in the comments below. Here's the key takeaway. VT's nearly 10,000 holdings dwarf VOE's 185. We're talking 50 times more diversification here, completely different investment scales. In plain English, here's the egg basket analogy. VOE spreads your investment across just 185 stocks, while VT diversifies into nearly 10,000. If one company crashes, it'll hurt VOE 50 times harder than VT. But here's where it gets interesting. VT spreads 38% of your money across international markets. Real global diversification that goes beyond just US borders and currencies. Let's get into the weeds here. VOE is basically a pure US play with just 1.2% international exposure. You're betting on America here, nothing else. Let's go zoom in on this. VT's global reach is massive, 38% international versus VOE's tiny 1.2%, showing completely opposite views on diversifying beyond US borders. In plain English, here's the pizza slice analogy. VOE sticks to American markets almost exclusively, while VT spreads your money across Italian, Japanese, and European markets too. Different geographic flavors mean you're exposed to different economic risks. Let's go zoom in on this. VT goes all in on tech with a 26% allocation, betting heavily on innovation and growth in this sector. VOE's value strategy shows here only 11% in tech, deliberately avoiding those pricey growth darlings that dominate the market. Here's where the story takes a turn. VT's 26% tech allocation dwarfs VOE's 11%. That's why their performance has been so different lately. In plain English, VT bet big on tech rockets shooting skyward, while VOE kept its feet planted in old-school value stocks. It's like choosing between a SpaceX launch and a reliable pickup truck. Here's where the story takes a turn. VT's price-to-earnings ratio sits at 18.4. You're paying over $18 for every dollar these companies actually earn. Now for the real question. VOE's built for bargain hunters. You're getting classic value investing here, paying lower multiples for your positions than growth funds. Let's dig into the details. VOE's cheaper at 13.9 versus VT's 18.4. You're paying 25% less per dollar of earnings with the value fund. In plain English, think of the price-to-earnings ratio as report card pricing. VT charges premium tuition for A students, while VOE offers discounts on B students who might surprise you and become valedictorians someday. Now let's put this in perspective. VT's dominance is clear. 69% three-year returns, recovery in just 38 days versus VOE's 136, and massive diversification with nearly 10,000 stocks spread globally. That's comprehensive market coverage working in your favor. But wait, there's more to this story. VT's growth potential commands premium pricing. Investors willingly pay higher multiples when they see strong revenue expansion ahead. Here's the thing though, VOE's trading at half the sales multiple of its benchmark. That's where you'll find those classic value stocks hiding out. Let's take a closer look. VT costs exactly twice what VOE does, 2.2 versus 1.1, showing you're paying double for growth exposure here. In plain English, think of the price-to-sales ratio like navigating stormy ocean waters. VT pays premium prices in expensive districts, while VOE finds value in calmer, up-and-coming neighborhoods. Same business fundamentals, just different market conditions. But that's not the whole picture. At just 0.06%, VT's fee is incredibly low. You're getting the entire world's stocks for pocket change annually. Let's see how this plays out. VOE costs 0.07%, just 1 basis point more than its competitor. Still dirt cheap, barely noticeable for most investors. Here's what really matters. 1 basis point won't make or break your returns. Both funds deliver rock-bottom costs that let you keep more money working. In plain English, both funds charge pennies per $100 invested. The difference? Finding 1 extra penny in your couch cushions. That's how tiny these expense differences really are for you. But hold on a second. VOE's dividend yield hits 2%. That's meaningful income for investors who need their portfolio generating actual cash flow. Let's unpack this a bit. VT's 1.8% yield is respectable, but it trails VOE, less income in exchange for broader global diversification across all markets. Here's the key takeaway. VOE's 2% yield beats VT's 1.8%. That's the value stock advantage, consistently paying out more cash to investors. In plain English, think of dividend yield like leaves growing on your investment tree. VOE drops more fruit regularly, while VT focuses on growing taller. Do you need income today, or can you wait for future growth? Let's break this down further. VT's dividends grew 10% faster, a solid sign that the companies underneath are thriving and sharing profits consistently. Let's get into the weeds here. VOE's dividend growth crawled at just 5%. That's half VT's rate, meaning your income grows much slower here. Now let's shift gears and look at VT's dividend growth at 10% doubles VOE's 5%. But VOE likely starts with a higher yield, creating very different income strategies. In plain English, here's your dividend growth analogy. VOE's like a marathon runner who starts fast but slows down, while VT paces differently, building momentum over time. Different strategies, both can finish strong. Let's zoom in on this. VT crushed it 69% of the time with better risk-adjusted returns, leaving VOE's 40% win rate in the dust. Now for the real question. VT's faster recovery shows real strength, bouncing back in just 38 days versus VOE's 136, with a smaller crash too. Here's where the story takes a turn. VT spreads risk across nearly 10,000 stocks worldwide, while VOE concentrates heavily in just 185 US companies. In plain English, VT's the champion here. Like a racing athlete, it delivered faster returns, bounced back quicker from setbacks, and showed superior stamina through global diversification. VOE tried hard but just couldn't keep up. Let's dig into the details. VOE's got value appeal, trading at 14 times earnings and 1.1 times sales, plus you're collecting income while you wait. Now for the real question. VOE's nearly matched VT's returns at 67% versus 69%. Value's finally catching up after years of lagging growth. In plain English, here's the marathon analogy. VT sprinted ahead early, but VOE's closing the gap as time goes on. In ultra-long races, cheaper valuations might just cross the finish line first. Here's where things get revealing. VT takes the crown, beating VOE on returns, risk management, recovery, and diversification. You'll just sacrifice some income and pay slightly higher valuations. In plain English, this is victory domination at its finest. VT swept the board in almost every metric that builds long-term wealth. VOE brings value and income to the fight, but can't match VT's execution excellence. But wait, there's more to this story. So which fund's right for you? VOE for steady value income, VT for aggressive global growth. Both need that 10-year commitment. In plain English, VOE's the chess player waiting for the perfect move, while VT attacks every square on the board. Your choice really comes down to whether you've got the patience for value investing or prefer owning everything. That said, you're responsible for your decisions. Do your homework, talk to professionals, invest smart. Now here's where it gets tricky. That's a wrap on our ETF breakdown. Hit subscribe if you want more analysis like this every single week.